Hi, the focus of this mini lecture is analyzing and recording sales transactions under a perpetual inventory system. And again, I'm using notes that can be found in the Chapter 6 folder in Blackboard. Okay, so as required by the revenue recognition principle and the 5-step revenue model we learned in Chapter 3, merchandisers record revenue when they fulfill their performance obligation by transferring control of goods to customers. And we spoke about this in the last mini lecture when we were talking about purchasing merchandise that we intended to sell later. We call that inventory. And we talked about shipping terms. The transfer occurs when a customer buys and takes possession of goods. Now, if we're at Walmart or Target, that might be at the checkout. But for a wholesaler, the transfer of control occurs at a time stated in the written sales agreement, and it occurs at either one of two times, at the shipping point or at the destination. When the sales terms are FOB shipping point, transfer occurs right at the shipping point. That means that the buyer owns them from the moment they leave the shipping point or the shipping department of the seller. And consequently, since they own those goods at that point, they then have to pay for transportation costs to get them to wherever they want them to be delivered. And by the way, our textbook assumes all sales occur FOB shipping point. In reality, most do. The other possible term is FOB destination. And in this case, the sale is recorded when the goods reach their destination because that's when the transfer of ownership or title occurs, when they reach wherever the buyer designates they should be delivered. Since the seller owns them during the shipping process, the seller has to pay for freight. Okay, so our sales transactions in a perpetual inventory system are more complicated than with a periodic system. We have two journal entries that need to be made or prepared. The first journal entry records the sale at the selling price. So we increase our sales revenue account and we debit to increase either cash if we're getting paid cash or accounts receivable. So that entry occurs at the selling price. The second journal entry updates your inventory account. We credit to take out of inventory the cost of what was sold. Because remember, in a perpetual inventory system, we always have to update that inventory account. And we debit the expense account called cost of goods sold. It doesn't say expense next to it, but it is an expense account. Right now, we can calculate how much money we made on the sale. The selling price of what we sold is $400. The cost of what we sold is $350. So the gross profit would be $50. And remember, gross profit is a calculation. It's not an account. It's not something we record in a T account. It's simply the difference between the selling price of what you sold and the cost of what you sold. Now, in the real world, a company might have several sales revenue type accounts. They might have, for example, clothing sales, household goods sales, grocery taxable sales, grocery non-taxable sales, so that management will know how much they're selling of each product line and how much gross profit they're making on each product line. We're going to keep things simple by just using one sales revenue account. And in the real world, when companies are reporting to their external users, they collapse all of their various revenue accounts and cost of goods sold accounts into one category, just like what we're doing. Okay, now let's talk about returns and allowances, because in the last mini lecture we learned about what happens when the buyer returns goods. Now we're talking about it from the seller's standpoint. When goods sold to a customer arrive in damaged condition or are otherwise unsatisfactory, the customer can return them for a full refund or reduction in the amount that they owe. Or they can keep them and ask for a reduction in the selling price, which we call an allowance. So we would need to decrease the sales account to reflect that those items are no longer sold if it's a return. If it's an allowance, we need to reduce the sales account for the amount that we won't be receiving because we've granted an allowance. So just like with purchase returns, sales returns are the exact opposite of the two sales entries. However, if we're talking about an allowance, we would not do the second entry bringing the inventory back because it will not be returned to us. The customer is keeping the goods, we're just giving them a price break. Now you might be wondering what happens when you're issued a store credit rather than a cash refund or a direct reduction to the accounts receivable account. When you're given a gift card or some type of other document that indicates that you've got store credit, what will happen is instead of crediting cash or crediting accounts receivable, we would credit deferred revenue because a customer will later on use that store credit or gift card. So right now it's deferred until they use it. Okay. Now we've got this area in our notes called expected returns. We want to make sure we do not show our sales at an amount greater than we truly expect to collect from our customers. And most often we're reducing sales by actual returns. But if you're at the end of the month, you may want to do an adjusting entry to record further returns and allowances that are expected in coming months. Now, I'm not going to request that you know this. You don't have to. If you're an accounting major, you should look over this section and be familiar with it. But if you're not an accounting major, don't worry too much about it. But it basically says that we're going to debit sales revenue and credit a refund liability for expected merchandise that will be returned in the future, and then debit inventory for an estimated amount of returns and credit cost of goods sold. Again, I'm not requiring you know this, nor will you have to do any homework problems, but for those of you who are accounting majors, please do look through it, and especially this section of the text. Okay, now let's talk about sales discounts. Just the way we discussed purchase discounts, you as a seller may offer to your buyers a discount to entice them to pay you earlier. Why would you do that? Well, you're not getting that money. What's so attractive about giving them a discount and not getting paid? Well, the thing is, if you get paid earlier, then you can use that money to buy more inventory and sell more and generate more gross profit. So just like we discussed with purchase terms, the number before the slash indicates the discount percent. The number after the slash indicates the discount period, how many days the buyer will have to take the discount, and then after that, they have to pay the full amount. Okay, now in this handout, in these notes, we don't indicate here a sales, a payment of an accounts receivable by a seller, but in our Chapter 6 Accounting Essentials notes, I wanted to show you how this would be handled. Our amounts are a little bit different here, but in our case, there was a balance due of $10,000 from our customer. Remember how I said that with purchasers, when they're paying a bill, they should debit the full amount or the gross amount that's owed according to their records, even if they're paying less, because you don't want it to look on your records as if you still owed, in this case, $200 in your accounts payable account. So if you would have just debited accounts payable for $9,800 and credited cash for $9,800, you would still have a balance in your accounts payable account of $200, and you really don't owe that. The seller told you could pay less if you paid early. Well, the same thing goes for your customers. If you give them a 2% discount and they owe you $10,000 and they're paying you within the discount period, then you need to credit their accounts receivable account for the full amount that's owed, even if they're paying you the amount less the discount. Otherwise, it will look like they still owed you that $200. So we debit cash for the amount of money we're actually receiving. We debit sales revenue to reduce sales revenue by the amount of money you're not getting because you're offering your customers a discount, but you credit accounts receivable for the full amount that that customer owes you. Okay, one more thing here. And again, this is something that I'm not going to be requiring you to know for homework problems or for the test, but I do want to mention this because this is something that occurs often in real life. I apologize, let me flip back over. This is page 271, and this involves the sale of bundled items. I'm going to zoom in a little bit. Okay, so here's an example. We've got SiriusXM selling a vehicle equipment kit and a 12-month radio service package for a combined price of $200. So we've got the equipment and the 12-month service bundled together. Separately, the equipment sells for $100. The radio service sells for $150. So if you add those two together, that comes to more than what the customer is paying for the bundled service and equipment. Now, the performance obligation for the equipment, that's satisfied the moment that that equipment is given or delivered to the customer. But the radio service occurs 1/12 each month. You earn it 1 month at a time. So how do we record this? Well, according to the 5-step model, the first step is to identify the contract. What are the rights and obligations indicated in the contract? Well, the equipment gets delivered right away. The radio service gets delivered 1 month at a time. That's the contract and the performance obligations. Step 3 is to determine the transaction price. Well, we said that the total is $200, but we have to split that between the equipment and the service, and the problem is that we can't use what we normally charge. Normally the equipment is $100 and the service is $150. That totals $250, and we're only asking our customers to pay $200 for the bundled service. So we would create a fraction for each. The amount of the equipment divided by the equipment and the service added together if they were purchased separately, and that equals 40%. And then the amount of the service if purchased separately divided by the equipment and the service added together if they were purchased separately, and that would be 60%. And then we would take those percents and multiply them by the bundled price to split it up, so that $80 would be the amount attributed to the equipment and $120 would be attributed to the music service contract. Okay, so when you first receive payment, you're going to debit cash and credit deferred revenue for the entire amount that you receive. On October 31st, if the equipment is delivered, you can then debit deferred revenue and credit sales revenue for the amount attributed to the equipment. And then, of course, remove that from inventory as well. But what about the service? Well, you're going to be delivering it 1 month at a time beginning November 1st. So at the end of every month, beginning with November, you'll be doing this journal entry. You're going to be debiting deferred revenue and crediting service revenue for 1/12 of 120, which is $10 a month. And that ends our lecture on recording sales transactions. The next mini lecture will be a demonstration of a problem dealing with sales transactions. Have a great day.